Hello everyone, here is the answer to exercise 1 from unit 5 of AC201. In this unit, what we are doing is we are adjusting values using the time concepts of money. So we're figuring out what an investment will be worth to us in the future, or the opposite, we're figuring out what an amount owed to us far in the future is worth to us today, because a dollar today is worth more than a dollar 5 years from now. To do this properly, you really need to understand the different, as they call them, factors, the different formulas you use to figure out how to adjust this value using the time concept of money. The first one we have here is the present value of 1, also referred to as the present value of the lump sum. You would use this one if you need to determine what the discounted value of a lump sum to be received in the future is, essentially figuring out what the value of it is today as opposed to what it's going to be worth years from now. And if someone has to wait for payment for a period of time, well, no one's going to buy that investment from them for the same amount today. If someone had, a $20,000 bond owed to them, but it didn't mature for 3 years, no one's going to pay $20,000 for it now. Why would you pay the same value you're going to get in the future if you have to wait those 3 years to get it back? You would have to discount it. And to do this formula to figure out the present value of a lump sum, the formula is future value divided by 1 plus the interest rate to the power of time, or to the power of the number of times interest will compound on that investment. Somebody somewhere went through and they figured out what they call factors. The portion of this that says 1 plus interest to the power of n. The numbers that are in this table are every possible combination you could have there. So if your interest was 1% and your n was 2, that number would be 0.9803. If your interest was 8% and your n was 14, your factor would be 0.3405. Essentially all you're doing, instead of having the portion that's in parentheses, you're just substituting the number off the chart into that spot. The next formula you can use is the present value of an ordinary annuity. The present value of a lump sum is when there's one payment coming in the future. What this calculates is what the present value is of a stream of payments that are coming to you. So if you had an annuity that you own that paid you $10,000 a year for the next 10 years, that'd be $100,000 in total that you would get. But if you wanted to sell that annuity to someone else, no one's going to give you $100,000. Again, why? Because why would they give you the amount of money now that they would have to wait to collect in the future? And the formula for this is listed on this page. Just like the present value of 1, someone went through and figured out the factor. So everything in that formula except for the PMT, the payment, computed for all of the different combinations of interest rate and number of periods and came up with these numbers. The present value of an annuity due. What is the difference between an annuity due and an ordinary annuity? It's the time that you get it. In an ordinary annuity, the payments come at the end of every period. If it is an annuity due, the payments come at the beginning of every period. Besides that, it's pretty much exactly the same. The only difference between this formula and the ordinary annuity formula is after you solve it, you once again multiply by 1 plus rate to account for that extra period that you get because it's happening at the beginning of the period instead of the end. Those were present value, converting amounts in the future to what they're worth today. The opposite of that is future value, converting what is worth today to what will be worth in the future on investments which earn some kind of return. The future value of 1 is if you made a deposit today of 1 lump sum, determining what it would be worth n periods from now. So if your company had $20,000 in excess unrestricted cash flow, and instead of just having it sit around doing nothing, they decided to buy some kind of investment with it to maximize their income. They put the $20,000 in, say they keep it invested for 5 years, they're going to get some kind of return off of that investment. Well, what is the amount of return going to be? That's what you use the future value of 1 for. And the formula for that is future value equals present value plus 1 times 1 plus r to the power of n. Again, there's a chart for this that has all of the different combinations of your rate of return and your n, your number of compounding periods. So that goes into the formula and it substitutes for everything except for PV, the present value. And then lastly, we have the future value of an ordinary annuity. That is when you are going to put in a series of deposits. And whatever your depositing that money in is earning a return of some sort, usually interest or maybe dividends. If you continue to make a series of payments, what's it going to be worth at some point in the future? So if you had excess cash flow, but this time instead of doing one lump sum, you decided I'm going to put $1,000 into this investment every month for the next 5 years, that is an annuity, because an annuity by definition is a stream of payments or deposits that are of the same exact amount, and they're made at regular intervals. So in exercise number 1, you're given a bunch of situations, and you're asked to figure out what factor you're going to use, what formula you're going to use to compute this to figure out your answer. In the first one, we have Greenway Food Company, and they plan to deposit $10,000 into a savings account on January 1st, 2019, and leave that money invested for 4 years. They want to know how much money will be in that account after 4 years. So if we deposit this, it's not going to be worth $10,000 in 4 years. Why? Because it's going to be earning interest the whole entire time it's there. We know how much we're putting in today, the present value, and we're looking for 4 years from now, the future value. Are we putting in one lump sum, or are we putting in a stream of payments? We're making a one-time $10,000 deposit. So the formula or the factor that we would have to use is the future value of one, or the future value of a lump sum. In our second situation, Greenway Food Company plans to rent out unused office space to Grubco Incorporated. Grubco is going to pay rent on the first of every month, and they're going to rent the office space for no less than 2 years. Greenway wants to figure out how much this future cash flow is worth in today's money. So what we have here is a series of payments. They're paying rent every month, right? And since it's a series and you pay rent in the same amount every month, that's an annuity. Is it an ordinary annuity that's happening at the end of each period, or is it an annuity due that's happening at the beginning of each period? Well, they're paying rent on the first of every month. So we have this series of payments in the future that is coming to us that's going to occur at the beginning of every period. The factor we would use is the present value of an annuity due. In situation 3, Greenway Food Company's employees contribute to a pension plan. And under this pension, Greenway will make monthly payments to former employees at the end of each month for as long as they are retired. The company wants to know what amount it should report for its future pension obligations. So we have a series of payments that we're going to make in the future. We want to know what is our current obligation now. What should we put down for liabilities? Well, we know it's a series of payments into the future that we need to find out what it's worth in the present. So it's going to be present value. It's a series of payments. We pay the same pension every month. That is an annuity. Is it an ordinary annuity or an annuity due? It depends on what time it gets paid. It's at the end of each month. So it is an ordinary annuity. The factor we use is the present value of an ordinary annuity. In the fourth situation, Greenway Food Company plans to issue 10% 3-year bonds in order to raise capital. The current market rate for similar bonds is 8%, and Greenway's accountants want to determine what price they can issue these bonds at. These bonds pay interest on December 31st, the end of every period. Well, what factor are we going to use here? For bonds, it's tricky because there's two things, right? If you have a bond, you receive a series of interest payments as your return each year until the bond matures. In this case, it's a 3-year bond. 3 years from now, that bond will mature. At that point, we get a lump sum back. We get our original investment. So there's actually two factors that are used here. For the lump sum that we're going to receive 3 years from now, in the future, we want to know what it's worth today. So that would be the present value of 1. For that series of interest payments that we're going to have to, pay out, what is that worth today? And since it's a series of payments, it's an annuity. It's happening on December 31st, the end of the period. It is an ordinary annuity. In our next situation, Greenway has the option to lease a piece of equipment or buy it outright. If the company leases, it will make lease payments on the last day of each month. And Greenway wants to know which option makes more economic sense to the company, to buy it or lease it. Well, to do so, we can't just consider our payments to be of present value right now. Think about it this way. If you had the option of paying $100 a month for a year, or you had the option of paying $1,200 now, which one would you take? You would always take the $100 a month for the year. You're paying $1,200 either way, but in the second situation, A, the payments are smaller, and B, you get to defer them to later on so you can do other stuff with the money. Well, we got to discount that series of lease payments that we have to make back to their present value. And because we are making this series of payments on the last day of each month, it is an ordinary annuity. So the factor or the formula we're going to use is the present value of an ordinary annuity. Next up, Greenway Food Company plans to deposit $25,000 into a mutual fund and do so on January 31st, 2019. They're going to reinvest all proceeds from this investment back into the fund until December 31st, 2025. Greenway plans to withdraw the funds from the mutual fund on January 1st, 2026 in order to pay off a debt obligation. So what's happening here is our company probably has outstanding bonds, and they're going to mature on January 1st, 2026. We have the money right now, and we have it set aside, restricted for the purpose of paying off this future debt. But why just have it sit there and do nothing for all this time period, when we can invest it into something and make a return while we're waiting for that time to come up? So if we have $25,000 that we know we're going to have to pay out on January 1st, 2026, and we have it now, let's invest it in something. Let's deposit it into this mutual fund, and it'll be worth more in the future because it's going to be gaining interest the whole time than it is today. It's one lump sum. We're finding out what it's going to be worth in the future. It is a future value of 1. It is a lump sum. Next up, Greenway has the option to sell $100,000 worth of inventory to a customer on January 1st, 2019. This customer will be allowed to defer payment until December 31st, 2020, at which time Greenway will be paid in full. Well, if they were giving us the $100,000 that we are, selling to them today, it'd be worth $100,000 today, because today is today. That is the present value of it. If we're waiting an entire 2 years to collect that $100,000, that's not as good as getting $100,000 today. So what is that $100,000 one-time future payment worth to us today? Well, figure that out. We're going to have to use the present value factor. And since it's a lump sum coming on December 31st, 2020, it is the present value of 1. Next up, Greenway Food Company has an excess of free cash flow. In order to maximize our earnings, we're going to deposit $4,000 on the first of each month into a money market account which earns 3%. Greenway's accountants want to know how much money will be in this account after 3 years. While we're making a series of payments, trying to figure out what it's going to be worth in 3 years. That is the future value of an ordinary annuity. And then lastly, Greenway can issue 6% 10-year bonds at a discount. The company's accountants want to know what the issuance price of these bonds should be. Same concept we had earlier. Bonds have 2 components: the principal repayment that you get at the end, plus the series of periodic interest payments you make. In this case, we're paying out, so it's the amount that we have to pay when the bonds mature, plus that series of interest payments we have to pay to our bond holders. We're going to need 2 factors here. We're going to need the present value of 1 for the principal that's going to be due on the maturity date, and we need the present value of an ordinary annuity for that series of interest payments we're